Welcome to the second installment of tutorials. If you've not watched the first installment on buy and sell lines, then we need you to get out of here, go and watch those first. You shouldn't be peeking this far ahead just yet. If you have watched those videos, then welcome to the next set. What we'll be teaching you now is the reversal patterns. These are probably the most important formations that we're going to teach you. The reason for that is they show you when an old trend is ending and a new one is about to start. Identifying that transition period can be so key to your trades. What we would say is that it must have a trend to reverse. Sometimes on what's called a trendless chart, where the market is pretty much going sideways, you can get one of these patterns show up. But what we would say is if there's no trend to reverse, then it's not a reversal pattern. It just looks a little bit like a reversal pattern. So treat it with suspicion and do not trade it the same way. We have quite a bit to show you, so let's go on and show you what the first reversal pattern you'll be studying is.
This is the double bottom formation. It occurs at the extreme lows of downtrends. You see how this market is putting in lower lows and lower highs. So each high is lower than the previous high and each low is lower than the previous low. The market bounces and puts in a lower high. So this is a typical descending market. After we put in our lower high, the market comes back downwards, but instead of putting in a lower low, it actually matches the same low. The market then starts to rally, and this can be the point where the downtrend reverses into an uptrend.
So we know what the pattern looks like now. Let's explore the psychology behind it, why it works the way it does. If we think of an example, let's say Barclays share price is going down, it hits a low point and then bounces higher. Now at that low point or around that low point, there's four types of traders with a vested interest in this share. You'll have the sort that buy the shares at that price and then the market bounces higher. They're quite happy with their purchase, but maybe they wish they'd have bought some more. You've also got the people who were watching on the sidelines. They were thinking of buying, but they thought it might go a little bit lower. By the time the market went higher, they missed their opportunity. They're a little bit mad at themselves, wishing they would have bought near the low. You've also got the people who watched the share price decline, who had previously bought. They sold their positions, thinking the market would go lower, and it didn't. So they sold near the bottom of the move. So they're a little bit mad at themselves. They would love to buy the shares back at the same price. And you've also got the fourth kind of trader, which is the short seller. They make money as the price goes down. They've seen the market declining. They think it's going to go lower, so they short sell the stock. And then the market goes higher. So they're starting to make a loss on that trade. They would love to get out of break even. So on this instance, the market comes down, it hits a low point, bounces. You've got four types of trader that would love to see the market come back down to the same price. It doesn't always happen, but when the market does come down to the same price, you've got the people who wanted to buy more that already own some stock. They get to buy more. You've got the people who were sitting on the sidelines. They finally get their chance to buy. The people who sold their position at that price get to buy their shares back. And the people that were short selling the market get to get out around break even and maybe even buy the shares themselves. So you've got four types of traders with a vested interest at that price, buying at that price. The market comes down, it hits the same low again, and then it bounces higher because of all the buying activity. That is why this pattern reverses the trend and why it works the way it does.
We need to look at the qualification criteria in actually calling this a double bottom. So the market comes down, puts in a low, it then puts in a high, a lower high, which is now resistance. The market bounces from the previous low. For this to be a double bottom, we must close above that previous high. The market must get up and start closing above that previous high. Then we have a textbook double bottom. We can trade it as a trend reversal. Otherwise, we just have a bounce from a previous low and we can expect this market to go lower. So we must start closing above that previous high. Otherwise, this is a pattern that looks like a double bottom, but it actually is just a bounce from a previous low.
At this stage, you will know nearly everything you need to know in order to trade one of these double bottom formations. One of the most important aspects when trading this pattern is to know the qualification criteria. The reason for that is quite frequently on stock market charts you get patterns that look like double bottom formations, but they haven't been qualified and they don't work the same until they have been qualified. And a lot of traders make the mistake of trading them the same way. Because of this, we've dedicated a big section to our ebook on the qualification of stock market charts when looking for double bottom formations. We will have a few examples. Only one, maybe some, will be genuine qualified double bottoms. Others will look similar but won't be the same. It's your task to go through these and work out which ones you think are genuine and which ones aren't. We also have a very clever measuring technique when looking at a double bottom formation to know how high the share should go. So if you are trading a double bottom, you know not to sell until you've worked out this set point. The next tutorial that you need to look at is the double top formation. We do make a recommendation that you do download the reversal patterns ebook if you haven't done so already prior to watching that tutorial.